Today we're going to be looking at Section 110 reconstructions in the context of MVLs, which is quite a complicated corner of solvent liquidation work. These are the points I'm going to be covering. I'll start by looking at what Section 110 actually says, what the conditions are for a Section 110 reconstruction. And I'll look at the sort of cases that Section 110 is actually used for and how a typical Section 110 transaction is structured. Following on from that, I'll then look at the professional team and look at who does what. It's one of the things that's different about a Section 110 MVL is that you tend to be running it as a project with a number of other professionals. It's not just you and the company, its directors and shareholders. And then towards the end of this, I want to look at the points that you would perhaps want to think about in terms of discussing the timetable with the others involved and seeing what's realistic for a timetable and the sorts of issues that are perhaps going to be relevant when you come to think about how to price the work. And after that, there will be questions. As I say, I try and keep these to about 30 minutes. I suspect that after about 30 minutes, I'll have come almost to the end, but I may not have got on to the bit about pricing the work. So if you want to slink away then, by all means do so. And if you'd like to stay and listen to that again, by all means do so. And it'll then be a few more minutes at that stage. So let's look at what is actually in Section 110 itself. First condition is that you have to have a voluntary liquidation. In theory, it could be a creditor's voluntary liquidation, but it's hard to think of circumstances where that would be appropriate. I guess if you had a CVL where you were selling the business for, well, to a connected party and you were getting enough for it that it was actually going to be able to pay all of the creditors in full, you might possibly be thinking about a Section 110 then, but I can't see that's likely to happen. I'm going to call the company that's at the centre of the process not Bustco in the course of all of this. Second condition is you need a transfer of business or property. It can be pretty well almost anything. And in theory, it can happen before the liquidation. In practice, I think you'd want it to be immediately after the liquidation. Third condition is that the purchaser has to be a company or an LP. It doesn't have to be a Companies Act company, it can be a bit broader than that, but it can't be a partnership, it can't be a single individual. And in those circumstances, Section 110 of the Insolvency Act can authorise you as the liquidator to take shares or something of that sort as consideration for the transfer of the business or the property, the shares being issued by the buyer company. And it authorises you to distribute those shares to the shareholders of not Bustco. So you never actually take the shares yourself, you just flip them sideways up to the shareholders. And you need a special resolution to authorise the Section 110 arrangement. It can be a specific resolution which is quite tightly tied to the particular transaction that is being planned, or it can be a very general authority. I have to say I prefer to see a specific resolution because these things are tax driven and it's often important to be able to show that you have actually followed the plan as intended. So if you've got a special resolution that authorises you to follow the plan for which tax clearance has been given and not anything else, then I think that's a useful document to have. And again, just looking at the very rare occasion when you might be doing this in a CVL rather than an MVL, you need a different type of authority there. You need the creditors committee to authorise the transaction in that case. There are two legal risks that you need to be aware of in a Section 110 reconstruction. The first one is the risk of insolvency, and this is triggered if a winding up petition results in a winding up order within 12 months. And if that happens, then that would invalidate the special resolution. If the special resolution is invalidated, your authority for the transaction is also invalidated, and you then end up with misfeasance, because you have, as liquidator, done something for which you have no legal authority. You have exceeded your powers. So this is one of those risks, very unlikely to happen, but if it does happen, the consequences are actually fairly ghastly. There are ways of mitigating it. The usual way of mitigating it is actually not an obvious one, but it is that in most Section 110 schemes, the company that is wound up is not actually the original company. What you find normally happens in a Section 110 scheme is that a new company is created specifically for the transaction. It is usually superimposed as a new holding company, and it is then liquidated within 5 minutes of it becoming the holding company. So it's a company that has a short but beautiful life, and the result of that is, because it has never traded, it has no liabilities. It has just been bought off the shelf, bumped in to do a particular job, and liquidated 5 minutes later. And that means that the chances of anybody having a sort of claim that could result in it being wound up through the courts is extremely remote. So that's the first and most common way of mitigating this particular risk. Second one, which I've never seen being done, and I can't imagine anybody would ever do, is you pass the resolution to authorize the reconstruction and wait for 12 months. Third one, which of course is always prudent in an MVL, is to make sure that the company involved is actually very solvent. And I think that's probably more important for a Section 110 reconstruction even than it is for the normal MVL. And the fourth one is to get a decent indemnity. I'm going to say a bit more about indemnities later on, because there is a bit of a nasty tax trap in the indemnities, in that you can actually trigger a stamp duty charge if the indemnity is not carefully drawn. I said there were two legal risks. This is the second legal risk, and it is the risk of having the whole thing overturned by a dissenting minority. The principle here is that any shareholder can object to the transaction, but two buts. First one is, if they actually voted for it, they've got no right of objection, which is fairly clear and logical. And the second one is, they have only got 7 days after the resolution has been passed to authorize the reconstruction, within which time to object. So they've got only a very short window of opportunity to object, and absolutely no opportunity to object if they did actually vote for the special resolution. The reasons why they might object could be either because they want to block the transaction completely, or because they want to sell their shares, and either purpose is legitimate. Now, there are ways of covering this risk off as well. The first one is, if you can actually get unanimity of the shareholders, there is no problem. The second one, which would be relevant if you've got a lot of shareholders, or minority shareholders who are not involved in this, who are difficult to get involved in all this, is simply to wait 7 days. And that's something that you might have to build into the timetable in appropriate cases. In other cases where you're involved far enough in advance of the planning, you could even have a discussion with the company and their advisors about perhaps making an offer to the minority shareholders in advance, so that if they want to be bought out, you've got arrangements in place to do that. And again, as with so many MVLs, you would want to get a decent indemnity. And again, remember the stamp duty track here. I'll go through a little diagram that will show how a Section 110 transaction would work if it just follows the basic outline mentioned in the legislation itself. And I've got a question here which says, do all the assets need to be transferred immediately upon liquidation? With the example being that there could be some assets which are not immediately realizable. You perhaps might need consent of a third party to transfer them. That's not a problem. And as long as the liquidator has got the authority of a special resolution for the transaction, it doesn't matter when the transaction is implemented. It would obviously be prudent to get the resolution before you do anything, but there's no reason why it shouldn't be done in phases. And if it is likely that it will take some time for all of the transactions to take place, that might even be something that's covered in the clearance letter itself. You might find that actually advises the revenue that it could take 3, 6, or 12 months for all of the assets to be transferred. Back to the transaction itself, we've got here a company owned by individual shareholders. It's solvent, and it owns a business property, a factory or something of that sort. And you would start by putting the company into liquidation. You would transfer the property to another company, which we're going to call Newco. Not very imaginative, I know, but so what. Newco would then issue shares to provide the consideration, the sale price for the property that is being transferred to it. And those shares would then be deflected by the liquidator, so that rather than going to Not Bust Co, which is the seller of the property, those shares actually go directly to the shareholders of the company. And in most Section 110 transactions, those shares are never part of the company's property at all. They just go directly to the shareholders. So at the end of that transaction, you have the new company owned by the original shareholders and owning the original property. The original company, Not Bust Co itself, is now an empty shell, having had its assets transferred out of it. Now, there's not really much point to that transaction because you end up with the new company simply stepping into the shoes of the old company, and not much has changed. The only circumstance in which I can think this might be useful is, I think, for some professional service companies. If you were to do this every few years and transfer everything cleanly and smoothly to a new company, it might be a way of mitigating the insurance premiums, because you would essentially be leaving the insurance risk behind as a contingent liability in the old company. And once that was dissolved and covered by the run-off cover, you'd find that probably the insurers would see the new organisation as being much cleaner and tidier. I don't know of any firms that are doing that, I have to say. So let's look at the sort of thing that you would typically use a Section 110 reconstruction. And this is so much the sort of thing you would see. It's a family company owned by, in this case, it's mum and dad, and it ran the family business, which was run for many, many years and very successful, and was then handed over to the children when mum and dad retired. And what we found over the years is that in this case the brothers and the sisters have taken an interest in different corners of the business, and those corners have been developing to the point where actually each one of them is pretty much a self-contained business. And it's now becoming a bit of a problem because the sisters aren't terribly interested in what's going on in the brothers' business, and the brothers aren't terribly interested in what's going on in the sisters' business, but nevertheless they have to talk to each other, and they have to make strategic decisions about the company as a whole, and that's just becoming complicated and difficult. So what they want to do is cut the company in two, and have the brothers' business owned by one company for which only the brothers are the shareholders, and the sisters' company similarly owned by a completely independent company owned only by the sisters. And this is very much the sort of transaction that people tend to use Section 110 for. There are tax benefits in doing this through a Section 110 transaction. I mean, there are other ways of doing this transaction, but the tax benefits usually mean that Section 110 is used for doing it. And the main tax benefit is that this transaction is purely tax neutral, so it doesn't trigger very much in the way of tax liabilities when it's done. And if you like, the tax history of both businesses are rolled over into the new companies. It is very important to make sure that a tax accountant is getting advance clearance for a scheme of this sort. And something else that is hugely important is to not do this transaction the simple, obvious way, but do it in a way that avoids having to liquidate the original company. And I say that's usually done by creating and interposing a new holding company, and then liquidating that holding company and distributing the shares in it as a way of making sure that the transaction happens the way it should. There are two reasons for that. The first one is the one that I've already mentioned, which is that it is much less risky for you as liquidator to be liquidating a company that has never traded. And in particular, you avoid the risk of somebody dropping in a winding up petition within 12 months of all of this happening. And the second one is a commercial benefit for the owners of the business, which is that if you liquidate the company that owns the business and transfer the business assets to a new owner, you may find that you are triggering various defaults, various breaches of covenant, and you may have to negotiate on a contract by contract basis to make sure that those defaults don't cause you a problem. And also it's quite a responsibility for anybody to review all of the contracts to make sure there are no defaults. It's something that people just tend not to do. So there are a couple of very, very sound reasons for sticking a new holding company into the group as part of the Section 110 reconstruction, and that should be part of the tax clearance as well. Tax benefits, broadly speaking, if the shareholders get any benefits in the course of the transaction, those are likely to be taxed as capital rather than income. The new company will be treated as acquiring assets on a no loss, no gain basis that should not trigger significant tax liabilities. Similarly, the shareholders are treated as their shares in the new company are treated as replacing their shares in the old company. You should avoid degrouping tax charges by splitting the business in this way, and that is one of the key reasons for getting the tax clearance. You should be able to exempt the stamp duty that would otherwise be charged on the share transfers, and as I've already mentioned, if you have indemnities that are too broad, you may put that at risk. So it's going to be important to make sure the indemnities cover that point. And you are very often going to be entitled, the new company is very often going to be able to claim acquisition relief, which will not eliminate stamp duty land tax, but will mitigate it down to 0.5%. You can't always get that, but when you can, it can be a huge saving. In extreme cases, a company with properties worth, let's say, £5 million could be looking at paying £800,000 in stamp duty land tax. More typically, it might be around £200,000. So if you can mitigate that down to £25,000, that really is a very significant saving. And again, emphasize this point, make sure that the tax accountant is getting advance clearance. The flip side of that particular coin is make sure that your engagement letter makes it abundantly clear that you are not giving tax advice on the deal, and that is for somebody else to do, which brings us neatly on to looking at who the professionals are in this project and who does what. So typically there will be I'll call them the chairman of Not Busco, because it will be it should be the director who is charged with looking after the interests of the shareholders in this, and they are likely to be almost everybody's client in all of this. The Not Busco's accountant has a sort of project management role in all of this, certainly in terms of managing the client relationship. And it's interesting. I mean, it is just coincidence, but I've actually been talking to I think 3 people in the last week or two about potential Section 110 reconstructions. The way they seem to come in is very often that you will have an accountant will contact you as a potential liquidator and say, I've got this liquidation that needs to be done. And in the course of you asking the usual questions, it becomes apparent that it's a bit more complicated than the usual liquidation is, and that there are some properties which are being transferred, or as I say, that the plan is to split the company into 2. And if it's a plan to split the company into 2, they probably won't even be talking about a liquidation at the outset. It'll just be a bit of a conundrum because they won't know how to do it. And so to be able to say Section 110 is extremely useful in a situation like that. Talking about this, I'll also mention that it's not necessarily the only way of dealing with something like this. One of the queries that I've dealt with in the last few days was a company with a pile of cash and a property, and they wanted to move the property into another more convenient company, and they wanted to get the cash out. And it seemed to me that one way of getting the cash out would have been simply for the company to buy back the shares, so that the shares disappear. They are sold, and because the shares are sold, albeit back to the company itself, that is then a capital transaction as far as the shareholder is concerned. And then I did think the company could be moved into the group where it needs to be, and there could just perhaps be an intergroup transfer. But that was the point at which I said somebody needs to go and talk to a tax accountant about how best to do all of this. Which brings me down to the next person on the list here, tax accountant. Say this is all about tax. You will have to follow the scheme clearly. The tax accountant should be seeking clearance for the scheme. In an ideal world, you would get to see the draft tax clearance before it goes to HMRC, and in an ideal world you would show that to me as well, and I can then spend a bit of time looking about how the liquidation would actually be implemented in terms of planning the particular transactions that are required to make it work. Because very often with tax clearance, you find that you go from A to E, but the clearance misses out intermediate steps B and C. So you've got A, D and E, and you then have to try and work out what those intermediate steps should be to make the transaction work. And of course, in doing that, you are then risking diverging from the tax clearance because they're not spelt out in the clearance that you've got. Which again follows on quite neatly to your job as a liquidator, is to follow the scheme as it has been cleared, to basically just do 2 main pieces of work. The first one is to liquidate the right company, and the second one is to distribute the right properties and shares in specie to the right people in accordance with the transaction. The third part of your job, which is the hardest part of this, is to keep everybody happy in terms of how much it's going to cost and the timetable for all of this. And I've got 2 solicitors listed here as being involved in this typically. And there is work that's needed to be done in terms of certainly the solicitor acting for the new company in making sure that the new company is properly constituted, set up, has all necessary resolutions, authority, constitutional documents, and that the properties are actually transferred and title is registered. And there's also the job of the liquidator solicitor to make sure that the liquidations, the distributions, the property transfers and the corporate transactions within the liquidation all follow the cleared scheme and the requirements of Section 110. And liquidator solicitor will actually be looking a bit more widely at that to make sure that the transaction is all happening as it should be. One of the problems that we do come across with this is that very often the chairman would like to use the firm of solicitors that they've always used, and they've usually got an extremely good relationship with the company and its shareholders, and they've done a great job in the past in terms of corporate transactions, property work, and probably sorting out some disputes for them as well. But they may not have seen very many Section 110 reconstructions, and you may find that the company's solicitor actually relies very, very heavily on you to explain to them what the legal workings of a Section 110 scheme are. And in some cases, you'll find that a property lawyer may simply default to the usual conveyancing experience and may not understand the importance of actually following the way it's set out in Section 110 and in the cleared scheme. And you may find that you actually need to steer them away from the documents that they would like to use for all of this, because they're actually recording a transaction which is different from the one that everybody else thinks that they're doing. So that's all part of the fun of it. In terms of the timetable, I'm just looking at the clock now. I've hit half an hour. I could do with another 5 or 10 minutes just to cover the timetable and the things that you need to be thinking about in terms of pricing the job. So my apologies for going a few minutes over, but please do bear with me if you're going to find this useful. I'll just go back. So yes, I say that what you may find is if you're instructed towards the end of the process where the tax accountant and the general practice accountant have already been working on this, you may find that the timetable is already very tight because they've left it until quite late in the day to instruct a liquidator. And these are the things you're going to have to look at in trying to assess how realistic the timetable is, whether the tax clearance is already in place. And it's good and bad news. If it is already in place, the timetable may already be quite urgent. If it's not in place already, then it may be bad news to tell people that it could take a little while for them to get it. There could be some quite important tax dates, and it's worth asking the accountant if they know what they are, if they can tell you what they are. You're going to have to spend a bit of time analysing the clearance and turning that into a complete transaction plan so that we have assessed what the stages in the transaction are. You'll need a bit of time to prepare the documents, both for the liquidation and the transaction. And then, of course, there will be the usual timetable that you work to for an MVL in terms of getting yourself appointed and doing the distributions. And in considering the timetable, don't forget there are also these legal risks. Those of dissenting shareholders, for which you may have to allow 7 days, and the risk of a winding up petition, which should not be a risk if the transaction has been planned sensibly with a new company being interposed into the group. Now, let's look at pricing the work. I think these are all factors that you're going to be thinking about in terms of looking at how much you ought to be charging for it. It's worth finding out how much tax is going to be saved by this transaction if you can, as well as looking at the value of the assets in the company itself. You should expect to be asked to give a fixed fee, and particularly once the clearance has been given, that's the point at which you should be able to define the work that's needed reasonably precisely. You should look at defining the scope of your work to make sure that it's clear what you are doing, very importantly, what you are not doing. It's worth noting that when a Section 110 does go wrong, it can be expensive, and so it's going to be quite important to make sure that it is clear who is doing what. It's clear that the tax accountant is responsible for getting clearance, and that your job is really simply to implement the scheme that other people have come up with. You should look at the company and the companies that you're liquidating, again, as you normally would with an MVL, and again, if it is an intermediate holding company created specifically for the role, that's nice and straightforward, because it will be coming, we would hope, without too much in the way of history to it. You should ask what the proposed timetable is. That's obviously going to be relevant to the amount of work that you have to do, and how urgent it is. You should check who is going to be doing the corporate transactions, setting up the new companies, just to make sure that firstly, it's not you that's being expected to do that, and secondly, to make sure that whoever it is who is expected to do that has got that within their own terms of reference and is including it in their own pricing for it. And you should check who is doing the legal transactions, and you should make your own assessment of how much assistance and guidance they might need for this particular transaction. So you'll also need to include the cost of your own lawyers, what work they will need to do, and examples here of the sort of work that we would get involved in with the Section 110 is to review and possibly tweak the indemnities, to review the company lawyers' paperwork to make sure that they're not knocking a hole in the scheme inadvertently there, and very often there'd be drafting that we ourselves would have to do in terms of the distributions, the resolutions, and the transfers of the assets. And something else that's very relevant to a Section 110 scheme that you don't get in a normal MVL is the amount of time that you are going to have to spend working with other people on this, because it's not just a two-way relationship between you and the company and its directors. You're also going to have to be liaising with the company's accountant, perhaps a bit more than you normally would, probably with the tax accountant, almost certainly with the company's solicitor, and also your own solicitor. So there's quite a lot more work involved there, in terms of simply just the project management and organisation itself. And so the pricing might reflect the value of the assets you're dealing with, the urgency of the job, the tax that's being saved, and the time costs. And I think you'd also want to have a quick look at the sort of costs that the other professionals are proposing to charge for all of this, to make sure that you're not too far out on a limb in terms of where everybody else is. And that's the end of all I wanted to talk about. So there is now time for questions. My apologies for overrunning by a few minutes. Please do bear in mind that MVLs are probably the most risky sort of work that insolvency practitioners get asked to do. And Section 110 schemes, because of the complexity of them, are probably at the most risky end of MVLs as well. And so they're a lot of fun. They're intellectually stimulating, but they are at the high risk end of the sort of work that we do. And on that cheerful note, I can't see any questions coming through, but if you have got any further questions to ask, please do so now or drop me an email later. So we've got one question now, which is just saying, what work would you expect to be done to estimate the market value of the assets being distributed for the purposes of the liquidator's receipts and payments? And I think there are three aspects to that question. The first one is in terms of the declaration of solvency and making sure that the company is sufficiently solvent. I think I'd probably be happy to work with the book values of the assets, and they should show that the company is massively solvent. You wouldn't really want to be doing this unless it were. In terms of the tax value of them, I think I would perhaps again just pass that particular point to the tax accountant and just ask them whether they think it's going to be necessary for the transaction to get up-to-date valuations of the assets or not. And I suspect, but I am just guessing here, I suspect it probably won't be, because the transaction, if done on a neutral basis, should be tax neutral. So I think the short answer is I don't think you would need to do significantly more work than you normally would to assess the value of the assets being distributed, but it probably would just be prudent to ask the tax accountant whether they would want a valuation, and possibly the lawyers might need a valuation for purposes of stamp duty land tax purposes. Again, the question that was raised earlier about whether the assets need to be transferred immediately upon liquidation, and what if there are some assets that are not immediately realizable. And I think the answer there is no, the assets do not need to be transferred immediately upon liquidation. There's no requirement for that the transactions to take place over any particular period of time. As I say, at least in theory, it would even be prudent to wait 12 months before distributing anything. But of course, if the assets are not going to be distributed immediately, then that is going to have an effect on the amount of work you have to do as liquidator, because the liquidation will have to be kept open longer than would otherwise be the case, and that should be reflected in the price that you agree for the job. So I think that probably is all. There are no more questions, so I will say goodbye now, and I hope to see you next week.